This is Business Weekend with Edward Boyd.
Hello and welcome to Business Weekend. I'm Edward Boyd. Coming up, gold sets new record highs again this week due to ongoing trade war tensions between the United States and China, and on speculation the US Federal Reserve will cut interest rates 2 more times this year. I have a broad conversation covering gold, President Trump's trade policies and China's rare earths restrictions with Jim Rickards, a former CIA advisor and national security strategist.
What's been driving the price of gold, and, going back to not that long ago when it was, $1,600, $1,700 an ounce, you had consistent central bank buying.
Prime Minister Anthony Albanese jetted overseas on holiday this week, leaving behind a supersized tax mess for the Treasurer to clean up. Jim Chalmers has scrapped the proposed tax on unrealised gains of certain superannuation account assets and will now allow indexing. A vocal critic of this policy, Jeff Wilson, will join us shortly.
How many times did he come out and say he is not going to change? He repeatedly said it's not up for negotiation.
Plus, it's mid-October, which means AGM season is heating up. Shareholder meetings are a time when investors can put tough questions directly to the leadership team. We'll unpack the key issues this year for investors with Rachel Waterhouse and Megan Motto, and preview some of the big upcoming AGMs, including CSL, which could be hit with a second strike due to underperformance. But first, are cracks emerging in Australia's economy? At the beginning of the week, money markets allocated just a 40% chance to interest rates being cut by the Reserve Bank next month. But on Thursday, Australia's unemployment rate unexpectedly surged ahead to 4.5%. That's its highest level in almost 4 years. And significantly, it's higher than the 4.3% number the Reserve Bank expects the unemployment rate to average until 2027.
But what was, more concerning to me in the data today was that usually when we see a spike in the unemployment rate, there tends to be a reason for it. One group that was coming into the rotation may have had, an abnormally high level of unemployment. But this time around, there wasn't really an explanation for why we had this big spike up in the unemployment rate. So I think it's basically a sign that all the different groups that are being surveyed in the labour force have been seeing high levels of unemployment. And it is really in line with some of the slowing that we've seen in forward-looking job indicators, some things like internet job ads, and what businesses are saying as well about future hiring intentions.
Since the jobless figures were released, the stock market surged to a new record high due to the chance of an interest rate cut lifting to 84%. The crucial piece of data the RBA are waiting to see is the quarterly CPI figures, which will be released at the end of the month, and that could force them to cut interest rates.
The CPI that's going to be out in a few weeks is all important. The monthly numbers, other indicators are telling us it's going to be a big number. And of course, this is inconsistent with the RBA view that inflation is coming back to the middle of the target band. In fact, there's every chance we will see inflation 0.5 percentage point higher than where they want it.
One of the shining lights for our economy this year has been the dramatic surge in gold and rare earths prices. Gold prices began the year at record highs at roughly $2,500 an ounce. The precious metal is now worth more than $4,000 and could surge above $5,000 before the end of this year. At the same time, simmering trade and tariff tensions between the United States and China have resulted in Chinese officials placing trade restrictions on their rare earths products. And this has presented an opportunity for Australian business. Treasurer Jim Chalmers was in Washington on Friday ahead of the Prime Minister's meeting with Trump next week.
We know that American companies desperately need critical minerals, and Australia is very well placed to service that need. This will be an important part of the discussions that I have with Kevin Hassett tonight. No doubt it will be part of the discussions that Prime Minister Albanese has with President Trump next week. The views that Secretary Bessent expressed is not the first time they've expressed views of that nature. I think when it comes to critical minerals, we are concerned that the market for critical minerals is not as reliable and robust as it could be when it comes to these supply chains.
So to discuss gold, rare earths and global trade, I spoke to Jim Rickards, an American author, investor and former advisor to the CIA. I started by asking him if gold could reach 10,000 US dollars an ounce. That's a number that the head of the JP Morgan Bank, Jamie Dimon, believes is possible.
10,000 is not out of reach. I don't put a lot of stock in what Jamie Dimon says. He's just jumping on the bandwagon. You know, we've been talking about gold for a long time. But but here's why 10,000 is not quite maybe as crazy as it sounds. In behavioral psychology, there's something called anchoring. And anchoring is when we get a number in our heads, we get an idea, and we just stick with it, and it kind of becomes a filter through which we evaluate everything. So just take the price of gold. And think of $1,000 an ounce as an anchor. So it goes up. Let's say you have 50 ounces in your portfolio. So if it goes from $2,000 to $3,000, you made $50,000. If it goes from $3,000 to $4,000, you also made $50,000. You're making $50,000 every time it goes up $1,000. But each one of those $1,000 increments is easier than the one before, because you're working off a higher base. So for example, going from 2,000 to 3,000, that's a 50% gain. That's a heavy lift. You go from 3,000 to 4,000, that's only a 33% gain. It's easier. Now, when you go from 9,000 to 10,000, that's only 11%. That's like a good week, the way gold's been trading lately. My point is, investors tend to think of 6,000, 7,000, 8,000 as they're anchored on these $1,000 increments. And that's right. And they do make $50,000 in my example, but they just get easier. And so the higher the price goes, the faster it will go to higher levels. So from the perspective of $4,000 an ounce, it's a little bit higher than that right now. 10,000 seems very far away. It's not. It could get there very quickly.
Yeah, what's the main thing really that you see that's been driving the price of gold higher? Has it been that economic uncertainty, or is it really just investors pouring more and more money into gold?
Well, started out with the former, and it's turning into the latter. So let me explain. What's been driving the price of gold, and going back to not that long ago when it was $1,700 an ounce, you had consistent central bank buying. And this is something I talked about in my first book, Currency Wars. I did a war game for the Pentagon. We talked about this a long time ago. In 2009, Russia had 600 metric tons. Today, it has close to 3,000 metric tons. Same thing with China. In 2009, they had about 600 metric tons. Today, they have close to 3,000 metric tons. That they acknowledge, they could very well have a lot more. I suspect they do have a lot more. But the point is, 2010 was an inflection point. From 1970 to 2010, central banks were net sellers. So the States sold 1,000 tons in the 1970s, even after Richard Nixon ended the convertibility to gold. And then we stopped. In 1980, the U.S. stopped. We stopped selling gold. There's a whole backstory to that. Maybe we don't have time to get into it, but the U.S. has not sold any gold since 1980. So take the U.S. out of the market. There's good reason to believe we cannot sell any more gold, having to do with how the Treasury got the gold from the Federal Reserve in the first place. But then we got other people to do our dirty work. So the UK sold about half their gold in the late 1990s. Switzerland sold 1,000 tons in the early 2000s. The IMF sold 400 tons in 2010. And that was it. That was it for major central bank sellers. Since then, it's been net buyers. Not the same central banks. It's been Russia, China, Kazakhstan, Vietnam, believe it or not, is buying a lot of gold. Iran, they're non-transparent, but they're a buyer. Turkey, and others. So the central banks, they don't want a price spike. They don't want a frenzy, because they're still buyers. If you were a buyer, you wouldn't necessarily want the price to go up that much, because you want to buy more. But the key is they sort of put a floor under the market. It's not a guarantee by any means. But when you have net buying by central banks, and they're going to continue that, it keeps the price of gold from going down very much. So you have what I call an asymmetric trade. You have very limited downside because of central bank buying, but you have unlimited upside because of the second thing you mentioned, Ed, which is, when does the retail investor get into the act? So in addition to central banks, that's the demand side. On the supply side, global mining output of gold has been flat for 6 years. I'm not saying it's peak gold. I'm not saying there's no more gold production, but it's around 4,000 metric tons per year, but it has not gone up a lot. So this is economics 101. When you have increasing demand and a fixed supply, the price goes up. That's just part of what's driving the market. But a good friend of mine, actually, you may know her, Tikki Folden, a very well-known Australian journalist, sent me a picture today from downtown Sydney of a queue of Australians lined up outside of ABC Bullion to buy gold. Now, that's the retail frenzy. They're not central banks. They're individuals like you and me. But when you see people queuing up to buy gold, you know you're getting to that takeoff stage.
Yeah, we actually spoke to ABC Bullion about that quite recently. It was phenomenal seeing the queues of people waiting to buy gold from their outlet in the Sydney CBD. But you mentioned Russia and China holding so much more gold now than they did back in 2010. I mean, what's that doing to the global gold market in general?
Well, as I said, it puts a floor under it. By itself, it's not going to take gold to $10,000 an ounce. But now that we have the momentum, you'll see hedge funds jumping in, sovereign wealth funds, high net worth individuals, retail. It's all kind of on one side where, again, fixed supply, increasing demand. But importantly, going back to what I said at the beginning, those hurdles, those $1,000 an ounce hurdles, they just get easier. For that matter, if you went from $19,000 to $20,000 an ounce, that's only a 5% increase. So my point is you'll just start to see big jumps happening almost on a weekly basis. You can get into a frenzy. That we're not there yet, but we do have very strong momentum, and I would expect this to continue. As far as the central banks are concerned, there's a lot of talk about China having a gold-backed currency. That's nonsense. They don't have anywhere. They have a larger money supply, believe it or not, than the United States, with all their money printing by the People's Bank of China, and they don't have nearly enough gold to back that. So you're not going to see a gold-backed yuan. You're not going to see a BRICS currency anytime soon. Maybe in 10 years, but not anytime soon. But there are a couple of geopolitical factors driving central banks into gold. One of them is that the United States and NATO, I mean, U.S. is part of NATO, but the NATO alliance and EU, they're in the process of stealing $300 billion worth of lawfully purchased U.S. Treasury securities from Russia. Now, these are U.S. Treasury obligations. Russia ran legitimate trade surpluses with oil exports. They took the dollars because the oil is priced in dollars, and they bought Treasury bills. They made the mistake of trusting the United States Treasury. And they had $300 billion, most of which was on deposit with a European depository called Euroclear. Now, here's the problem. It's one thing to freeze assets. The U.S. does that all the time. But here's the case where they're in the process of stealing the assets. It's a crazy plan. I think it's idiotic, actually. But what they want to do is take the Russian assets and use them as collateral for a loan that they would give to Ukraine to fight Russia. And then when Ukraine wins the war, Russia would have to pay reparations, and that would pay back the loan, and then maybe the assets would be returned.
Well, Jim, the other war that's going on at the moment really is the trade war between America and China. President Trump might actually meet with the leader Xi Jinping later this month in Seoul. Do you think a face-to-face meeting could really help repair the trade relationship between the two superpowers?
Well, I guess it can't hurt. It's always good to talk. I'm all in favor of that. But no, this is going to be a tough struggle. I have no doubt that the U.S. will win, but it doesn't mean that there won't be a lot of pain on both sides. Now, right now, China seems to have played a trump card, no pun intended, where they're cutting off exports of rare earth magnets, which are an indispensable component of electric vehicles, a lot of computer equipment, a lot of defense equipment. The rare earths are a critical resource, but the magnets that come from them are in a large array of devices. And if you cut those off, weapons manufacturing, electronics manufacturing, et cetera, are going to slow down. On the other hand, that's kind of all they've got. The U.S. is working as quickly as it can to find alternate sources. By the way, rare earths are not rare. They're called rare earths because they're very, you need a lot of ore to get a small quantity, but they're actually everywhere. They're all over the Western United States, Kazakhstan, Russia, elsewhere. They're not hard to find, but they are expensive to mine. And you can't build a mine overnight. It can take 4 or 5 years to build a mine. Having said that, the U.S. consumer has been the consumer of last resort for Chinese exports for 20 years. And they don't have other markets. They're being kind of walled off. The EU is trying to protect itself. The rest of the world isn't doing China any favors. I don't know how much good the relationship with Venezuela is going to do. That's probably coming to an end soon. The U.S. is practically at war with Venezuela at the moment. We're sinking their vessels, their drug vessels, as they leave the port. I mentioned they're having trouble getting crews because it used to be the Coast Guard would pull up beside you. They'd come aboard the vessel, find the drugs, arrest the crew, impound the vessel. Now they're just shooting them with missiles and everyone's getting killed, which is much more effective. But my point being, China doesn't have that many friends, and at least not the kind of friends who can buy their output the way Americans have. And I would say Europeans also, but the Europeans are starting to put up more barriers. So, and China is not just economic. We can discuss economics all night, but there's a political aspect to this. The Chinese have a deal with the people. We'll get you jobs. We'll, you're not necessarily going to be rich, but you'll have a good job and a good apartment and, decent food and a future for yourself and your family. That's starting to fall apart. Youth unemployment is approaching 30%. Now, I say approaching. We don't have the exact number because China stopped reporting youth unemployment about 5 months ago. When they don't like the news, they just stop reporting it. So, and this is very incendiary. So Xi Jinping has already lost a lot of power. He's been made subordinate to a commission where he now reports. That commission is headed by the head of the People's Liberation Army. So Xi Jinping's on the ropes. China's not as powerful as it seems. So are they doing some damage to the U.S. right now? Yes. But the U.S. has not begun to, fire all its trade weapons, if you will. So I expect that China will come around to the U.S. terms sooner than later.
Jim Ricketts, we've run out of time, but great to talk to you as always.
Thanks.
It's been a big week for the Treasurer. We just showed you footage of him in Washington, D.C., ahead of the Prime Minister's scheduled meeting with Donald Trump. But Jim Chalmers kicked off this week in the Blue Room at Parliament House, announcing a dramatic U-turn on his cornerstone superannuation tax policy.
I don't explain the retreat on every single point.
Well, first of all, I don't accept that because what we're talking about here is tax reform in super, which makes the system more sustainable.
How can this be interpreted in any other way than you've been rolled by the Prime Minister?
The Prime Minister and I agreed these changes. I recommended it to the colleagues. I've announced it within a couple of hours of Cabinet agreeing it.
Did you get rolled by the Prime Minister?
No, of course not.
We have known for a very long time that this tax is very bad for Australians, but the Treasurer refused to budge. Now, finally, the government has made the right decision to dump its superannuation tax regime that it was planning on introducing.
Well, for more on this, I'm joined by one of the prominent critics of the superannuation tax policy reforms, Jeff Wilson, Chairman of Wilson Asset Management. Jeff, thanks so much for your time.
Good to be here, Ed.
Do you think the Treasurer was rolled by the Prime Minister over the super tax reforms?
Oh, clearly. How many times did he come out and say he is not going to change? He repeatedly said it's not up for negotiation, even though it was a flawed, illogical tax, even though he wanted to focus on productivity, he said after the election. And if you want to probably introduce something that is incredibly negative for productivity, then increase the tax on assets that may never, the money may never be made. And,
the unrealised gains, proposed tax on unrealised gains, it was announced about 2 years ago. Yeah. That seems to be the one that a lot of people out there in the financial markets took issue with. I think it could have really affected self-managed super funds and the farming sector, for example.
Oh, 100%. I mean, there's thousands of farmers that had put their farms in their superannuation funds, and the change in the value of the assets, which may never be realised, they were going to have to pay tax on it. So how do they fund that? And you look at the the superannuation industry. We've got $4.2 trillion of long-term patient capital. 1.1 trillion that is self-managed super funds. Well, you're just discouraging them to make long-term investment decisions. And that's what you need for productivity. So what people would have done is they would have gone for more lower risk strategies, and the negative impact on the Australian economy was significant. We ended up having to do a whole lot of research. We did about 150 pages of detailed research, and the deadweight loss to the Australian economy was going to be $94.5 billion. So to me, the unintended consequences were going to be monumental to the Australian economy. And one of the incredible frustrating things is, why did it take so long? It was actually 2 3/4 years of pain, of uncertainty, and we know uncertainty isn't good for capital formation. People hate uncertainty. Why would you invest when there's an uncertain landscape? And that's what the Treasurer created for nearly 3 years.
Yeah, the tax on unrealised gains has now been scrapped, and large super funds will now be indexed as well.
Yes.
I mean, was it a surprise for you to hear the Treasurer make these changes on Monday?
Total surprise. Yeah, totally out of the blue.
Yeah, I mean, now that there's a new tax also that's been introduced, 40% tax on accounts of 10 million or more, that we never heard about that one before. So
well, I mean, we put the economic roundtable. A lot of people put submissions in. We put a submission and sent it to all the participants, and that was to, rather than taxing unrealised gains, and this was how do you increase productivity in Australia, is don't bring in what the Treasurer wanted to bring in, and that's tax realised gains. So we actually suggested a progressive tax, similar to what they came up with, to tax realised gains.
You've essentially been one of the people in the financial markets kind of leading the charge against these reforms. What really struck a nerve with you?
Oh, well, actually, it was interesting. The day they announced, well, take a step back, our job is to, we've got 130,000 shareholders. It's really to stand up for the mum and dad, the retail investor. Back in 2018, 2019, there was an illogical tax by Shorten and Bowen. They wanted to bring in on franking, so we stood up for that. In terms of when this tax was announced, the actual day it was announced, I got a call from a journalist and said, "Do you want to comment?" And that was putting the $3 million cap. And I said, "Look, this is our area. We're really focused on franking." The next day, they announced there was going to be this tax on unrealised gains, and we understood the negative impact that was going to have for the Australian population, for Australian companies, capital formation. And then we decided, look, we've got to stand up for what we believe is right.
Yeah, there were a lot of critics that started speaking about it. I mean, Paul Keating is one pretty vocal critic that's been talking for quite a while about these reforms. Do you think the PM put a bit of pressure on the Treasurer and the Cabinet came to an agreement to make some changes to this stuff?
Well, that's what it looks like. Like, to me, it looks like, that the Prime Minister had decided that he didn't want to create this, well, what Jerry Harvey said, this tax stupidity of the highest order. And it wouldn't surprise me if more of the rank and file Labor MPs also put pressure on them. We did a study that showed that if an election was held now, 30 seats would change because of the negative, as people understood the negative impact this tax was going to have.
There's also an opinion piece in the papers this week suggesting Jim Chalmers has actually gone with one of Trump's strategies, which is go hard with a big announcement and then in reality introduce something that's a lot more forgiving for people. Do you think there's much in that?
Well, I think if you paid attention to the Treasurer on the day of the press, the day he did the presentation on Monday, you'll see that he wasn't comfortable, and for him to be so blatant and say, "I'm not going to change this. I'm not going to change this," clearly, that he was lent on by other people. What frustrates me as an Australian citizen is why can a Treasurer be sort of hoodwinked by Treasury to bring in a policy that was going to have significant negative implications for any growth company in Australia and effectively all Australians.
All right, how do you think now markets and investors are going to react with the new changes, if they do get legislated over the coming months, I think they come into effect on the 1st of July 2026.
Yeah, I mean, an interesting thing is, both the 3 million cap and the 10 million cap are indexed. Now, the whole idea is, I'd say from Anthony Albanese's perspective, is we've got to support aspirational Australians. Well, if you really want to support aspirational Australians, then you index at least the $3 million by the growth in asset prices, not by inflation, which is 2.5%, because each year they'll be worse off.
Yeah, the indexing was an interesting one because clearly the government will get less revenue because the net will catch less people over time.
Yeah, and to me, this is how bad the policy was, and it's frustrating that again it took so long. Is a 25-year-old social worker or nurse would have got captured by the tax if it wasn't indexed, which it wasn't originally. But now at least those people will get a slight benefit, but they'll still be worse off each year that they don't put money in the super.
Jeff Wilson, Chairman of Wilson Asset Management. Great to have you on the show.
Thanks, Ed.
Well, coming up after the break, the AGM season is just kicking off. This week we heard from large companies like CBA, Origin Energy and Telstra. Next week includes BHP, Super Retail Group and Brambles. Our special AGM panel is up next. Welcome back. It's mid-October, which means we're starting to get deep into the AGM season. Annual general meetings allow shareholders to ask questions of executives, vote on various company items, including remuneration reports, and more broadly, just hold companies to account. Now, this week, there have already been several AGMs, including the Commonwealth Bank on Wednesday. So to preview this AGM season and some of the hot topics I'm sure shareholders are going to ask, I'm joined by Rachel Waterhouse, the CEO of the Australian Shareholders Association, and Megan Motto, Strategic Counsel at Codex Communications. Look, thank you both so much for your time. Rachel, I wanted to start with you. Just why are AGMs such an important time of year for shareholders to really get their message out there?
Yeah, it's a really important time to be able to see face-to-face the executives of an organisation and the directors and hear how it's tracking, but ask questions as well. So it's really an exercise in listening for a company is what we would expect, and for shareholders to have their say. And that could be that they're super happy with an organisation and it's how it's tracking, or there could be issues and they want to understand what's happened and how it's being resolved.
Yeah, Megan, behind the scenes from the corporate perspective, how much preparation is involved in getting ready for one of these things?
Yeah, look, a huge amount. We were just talking earlier, if you've got a physical AGM, you've got physical security issues these days to do with people turning up that shouldn't be there, or activations that can really disrupt proceedings. If you're running a virtual AGM, you've got all of the technology and cybersecurity issues involved. And if you're running a hybrid AGM, it's really interesting that people think it's just 1 + 1 = 2, and it's often the case of 1 + 1 = 3 in a hybrid sense, because you're really managing the risk of the interface between the virtual and the physical presence AGM. And then there's all of the messaging involved. It really is, as Rachel said, an opportunity for transparency from the company's perspective in terms of reporting, but also listening to shareholders. But that transparency comes with a balance. You want to be making sure that the message is authentic and in a way that the consumers, which are the shareholders, can understand, being that they're a broad church. But also you want to be giving that good news story as well, and presenting a really true picture of the organisation. So it's a really challenging communications message for organisations, particularly when times are not going so well and you've got some tricky issues to be accountable for.
Yeah, when companies are under pressure, there can be lots and lots of questions about the same issue. And as an executive or chair or CEO, you've got to kind of front up and really answer every question over and over again. That could be a big challenge.
I think it's a big challenge. What Megan has talked about, the authenticity of the conversation, is super important.
Yeah.
And shareholders see through that. If they're just hearing the buzzwords like AI over and over again, that's not going to help them. So they need authentic messaging and to be able to understand how that company is going. The importance of the hybrid meeting too, like just being able to, it is a challenge from a corporate side, from the company side, but a retail investor wants to be able to attend, whether they're in their workplace, at home, or in that city.
Yeah, well, retail investors have quite a lot of voting power at AGMs. We've got a chart we can show both of you from the investor research group Georgeson, which basically analysed all the AGMs in 2024. And it shows the number of remuneration strikes over the past 5 years has really escalated quite significantly from around in the 20s in 2019 up to the 40s in 2024. What do you think's been driving that change, Megan?
Yeah, look, shareholder activism has been, I think, increasing overarchingly over the last decade as shareholders do believe that they've got more of a voice, particularly retail shareholders who tend to turn up to AGMs. Often the institutional shareholders' votes are done and dusted before the day of the meeting. Mm-hmm. But that opportunity to have your say, to turn up to an AGM and to participate is, I think, that's something that investors often obviously find really valuable. In terms of those first strike votes that you were talking about, we are seeing an increasing amount of those as just a general vote against anything that's going on in the company that investors are generally unhappy about, because it's really the only opportunity they have under many circumstances to voice a really strong concern. So oftentimes boards need to think about what is the message behind the vote rather than just looking at it as a strict vote on executive rem.
Yeah, well, there's another chart from that same report which shows the percentage of shareholders voting on REM reports. It was averaging 91% in favour about 5 years ago. Now it's dropped down a bit to 88% in favour. So it seems like there's less support these days for remuneration reports. One company, a big one last year, was CSL, that did get a first strike against their REM report, and their CEO has recently announced a whole new strategy at the Bloods plasma business, but it hasn't seemed to have been received too well by shareholders at this stage.
Yeah, that's true. It doesn't seem to have been received when that announcement was made around the strategy. I think it's around listening to retail shareholders and finding a way to engage with them throughout the year in a practical way, because it's not always practical, and to listen to them around developing a strategy and then announce it, because there has been big shocks to the share price of CSL, particularly around those announcements. So I do think there is more work to do there for CSL to really engage with retail shareholders and to get their input and bring them on that journey.
Yeah, you can see CSL shares over the past 12 months down pretty significantly. But if you do get a first strike, Megan, as a board, what do? How do you get around this for next year? Because then you can get a second strike and there can be a board spill.
Indeed. And we're not seeing too many second strikes and moving towards board spills. So I think that most boards are really doing the right thing in looking at that first strike and saying, what is the message that we need to listen to here first and foremost? There's a couple of things they need to do from there. The first thing is that they need to really look at the governance around their remuneration strategies. So looking at the Rem and Noms committees, looking at the remuneration committees, looking at the remuneration reports, and making sure that they are transparent, they're authentic, they've got all of those elements that shareholders are going to be looking for in terms of the strategy around remuneration for executives. So that's really important just from a governance perspective in its own right. But then it's unpicking the other things that investors might be unhappy about, like the strategy of the organisation, and really, I think, leaning into better explaining the rationale behind that strategy. Ultimately, boards make decisions for companies. Shareholders don't. That's the Corporations Act. That's the world that we live in. But those boards do have an obligation to explain the rationale behind some of those decisions to shareholders.
Yeah, well, big strategy change as well just this week from ANZ Bank. Now, their AGM is going to be a little later this year. We had CommBank's AGM today. CommBank's AGM on Wednesday earlier in the week. One of the keys from CBA, I think you really wanted to hear your association from how long Matt Comyn might stay as chief executive.
Yeah, and we heard that this week that there is a plan for him to stay quite long, which could mean that their tenure is up to 10 years potentially. Retail shareholders are very happy with the job he is doing at CBA.
Oh, it's been phenomenal, hasn't
it? So he's doing an amazing job from the retail shareholders, what they have to say about CBA. So yes, he will stay. I guess that gives confidence to retail shareholders. And the other banks, there's a lot of conversation around strategy, changing strategy and their focus areas and cutting the workforce. And so what retail shareholders probably want to know around that is, well, what does that mean for the organisation? And, will they be able to achieve the strategy with those changes and manage it effectively?
Well, yeah, let's be honest. I mean, the banks are some of the most held. They're some of the biggest companies, firstly, in Australia, which everyone looks to as examples of good corporate citizenship. And they're some of the most held by all super funds and lots of investors.
Yeah, and look, there's going to be some really key issues for the financial services sector and the big banks in particular. I think first and foremost, cybersecurity is going to be front and centre of everyone's mind. How are the banks leaning into dealing with scams? We're seeing our inboxes flooded with emails purporting to be financial institutions asking us for all sorts of details. So how are they leaning into those? But also, how are they testing that the return on the investment they're making into cybersecurity is sound and is paying dividends? So there's going to be a lot of questioning around that. As Rachel has said, the AI strategy of the banks. I think, generally speaking, most consumers, most customers, most shareholders appreciate that AI is going to be the way of the future. It's about efficiency for the organisation, but it's going to be done in a governance framework that is ethical, that is responsible, and that balances the efficiency and accuracy of AI. So I think there's going to be a lot of questions around that, and a lot of questions in particular around how job displacement with AI is handled, not just from a strategic perspective, but from an execution perspective. We all saw the debacle of ANZ sending out emails incorrectly in advance of restructuring. So execution, I think, is going to be really important for some of these tricky issues. We know that we need to move. It's how you do that with respect and authenticity once again. And of course, cost of living is going to be top of mind for the banks and how they're relieving pressures for customers, particularly under financial stress. And the climate change reporting is going to be, I think, another really interesting one. Big organisations have been reporting on their climate change disclosure for some time, but increased scrutiny now that the government legislation has gone through for particularly third Scope 3 emissions.
Yeah, the Scope 3 emissions is a really interesting one. But all just on cost of living as well, we've got the two big supermarket chains, Coles and Woolworths. They're also very widely held stocks by thousands of retail shareholders out there. The past couple of years, Coles has really leapfrogged ahead of Woolworths. Do you think Woolworths board's under a bit of pressure this AGM season?
Well, I do think to a point, yes. I think the Woolworths strategy needs more clarity and communication, what we were talking before about the importance of that. Coles does seem to have really picked up their game, and Woolworths is, from a retail shareholder perspective, we're just not really entirely sure on that strategy and where it's heading. It is a challenge in our country having two main grocery stores, but yeah, it's like most shareholders will have the banks, they'll have a Coles or Woolworths in there. So just clarity on the strategy. I think the other thing we're talking about, AI and technology and the skills that sit around it. Another theme may be around the geopolitics of what's happening internationally with the US. And so a lot of retail shareholders will want to know, well, what does that mean and the impact of announcements that can be done daily, monthly, quite often, and what it means. So CSL is potentially impacted, and others are as well. And critical minerals could have a really beneficial impact as far as some of the companies that are involved in that. Yeah,
we've seen some big increases in the prices of gold and rare earths and things like that. But one AGM that I remember that I went to a couple of years ago was Qantas 2023 in Melbourne. They got a huge first strike against their remuneration report. A lot of protesting, angry investors in the room. Do you think now they're finally getting back on the right track?
Look, I think that they've certainly listened, but there's still a way to go in terms of restoring customer and investor confidence in the organisation and that critical trust that you need, that compact to run a really great organisation. Obviously, they've done a fair amount. There's, we've seen a change of CEO, we've seen a change of chair now happening, and so that will go some way, but I don't think that Qantas can just rest on its laurels. It's an incredibly competitive environment globally. It's got lots and lots of pressures, and I think that they've still got a little way to go in terms of bedding down some of those issues of the past.
And they have more competition now with Virgin backlisted on the stock market.
Yeah, they do. I agree with Megan on Qantas. We really need to see more demonstrated as far as that independent governance review and how it's tracking along. But time will tell with any major change.
Rachel Waterhouse, Chief Executive of the Australian Shareholders Association, and Megan Motto, Strategic Counsel at Codex Communications. Great to chat to both of you today.
Thank you.
Thanks.
After the break, investors are flooding back into the property market due to falling interest rates and rising rents. Roughly 1 in 7 Aussies now own an investment property. REA Group are up next.
at this.
Apparently down the road sold for 1.5.
I wonder what we get.
We could move back to the city for that.
This is great. Is north facing good?
Which way is it facing?
South facing.
Oh, look at those timber floors.
How many properties we seeing this weekend?
You, the city.
What?
I never thought I'd see the day.
Yeah, well, that was before the grandkids.
Keep moving with realestate.com.au.
What a hotel.
Right? And only $370 a night on my favorite site.
What? You didn't check Trivago?
I got mine for $250. You have to check Trivago.
Oh yeah? Prove it.
On Trivago, you can compare hotel prices from multiple different sites.
Even your favorite one?
Yeah, see? Same hotel. $120 less.
You didn't check Trivago?
I didn't check Trivago.
Check Trivago to compare prices and save up to 30%. Hotel? Trivago.
Washing machine's broken, Moose. But squeaky. Don't worry, we'll sort it. Squeaky will be fine.
ClearScore is a great place to find exclusive credit deals. For a limited time, get a gift card valued up to $1,000 on a personal loan with Now Finance.
Experience Scandinavia and the Baltics cruise from $6,999 per person, including flights. Set sail with Norwegian Cruise Line on an all-inclusive cruise to 9 iconic European countries. Search Trip a Deal now.
Is your hose heavy? Does it always kink? Come on! And constantly leak? Then it's time to upgrade to the best pocket hose in the world, the Pocket Hose Copper Bullet. With more than 100 patents worldwide, over 200,000 units sold throughout Australia, and amazing 5-star reviews, people are loving their Pocket Hose Copper Bullet.
This hose beats every other one, hands down. Everyone needs one of these. You'd be a fool not to replace your garden hose with a copper bullet.
The copper bullet is so light. I love it. I can't believe this little hose grows to 50 feet.
Just turn on the water and watch your hose grow and grow to a full-size 3/4-inch hose. And when you turn off the water, away it goes, shrinking and squeezing that water out until it's practically bone dry. The inner tube has 3 layers of high-strength latex. Then it's wrapped in a polymer filament jacket that's near impossible to tear or snag. And the connector protector with flexible collar helps stop leaks at the tap. The Pocket Hose Copper Bullet has oversized, easy-to-grip fittings. And the bonus Turbo Shot spray nozzle is perfect for washing vehicles or watering your garden. Now it's your chance to get the best pocket hose in the world. Call Global Shop Direct or go online now to get the Pocket Hose Copper Bullet starting from the low price on your screen. This incredible expanding hose is available in a 7.5, 15 or 30 metre length. And if you order now, you'll also get the bonus Turbo Shot spray nozzle, perfect for delicate flowers to washing your walkway. And you'll get a 30-day money-back guarantee and a 3-year warranty, because we're so confident that the Pocket Hose Copper Bullet will be the most durable and impressive hose you've ever used. Don't miss this fantastic offer. Get the Pocket Hose Copper Bullet in the length that's right for you, plus the bonus Turbo Shot spray nozzle and a 3-year warranty. Order yours from Global Shop Direct today.
Great idea!
Global Shop Direct!
This program is brought to you by realestate.com.au. Keep moving with Australia's #1 address in property.
Welcome back. Investors are roaring back into the property market and currently make up their highest share of lending since 2017. Roughly 1 in 7 Aussies own a rental property, and with interest rates still falling and rents rising, the outlook for investors has been improving significantly. A new report released by REA Group and Terry Shear this week has analysed this rising level of investor activity. So for more on this, I'm joined by Angus Moore, Senior Economist at REA Group. Angus, thanks for your time. What's really caused investor activity to surge over the past 12 to 24 months?
Great to be here, Ed. As you say, really the big thing that we're seeing driving investor activity at the moment is the fact that rental market conditions are just very, very tight. Rental availability is extremely challenging around the country at the moment, with vacancy rates at very low levels. That's seen rents grow very, very quickly, particularly in places like Adelaide, Perth and Brisbane. Over the past 5.5 years, rents in Perth have grown more than 80 to 90%, eye-watering pace of growth. That's obviously a very attractive environment for investors, and so that's what we're seeing. We're seeing a big pickup in investor activity over the past couple of years. Bottomed out as the RBA was raising rates really quickly in 2022, but it's really come back and much faster than other buyer groups.
Yeah, we've got a few charts from the report we can put up on the screen. The first one, you've done an analysis of investors themselves. It's a breakdown of roughly the number of properties an investor owns. And obviously, most people just own one property, but clearly there's quite a few investors out there with big portfolios.
Yeah, that's right. Investing in Australia is actually quite common, particularly relative to what's true in other parts of the globe. So around 1 in 7 Aussies own a rental property. Of those, the vast majority, about 2/3, own just one rental property, and then another about 1/5 own 2. But there is a tail of people who have much larger portfolios, and obviously they account for a larger share of rentals than they do of investors because they have very large portfolios and therefore account for more of the rental properties. Though, I wouldn't want to overstate the number of these sort of very large holdings. The number of investors with in excess of 6 properties is about 1%. So it's not a huge share of the population, but certainly still there.
Another chart we can show on the screen is the average age of investors that own a rental property. Clearly, it's skewed towards the more older people. Has that changed at all over time?
Yeah, it has, which I think is quite an interesting change. What we've seen is that the share of investors that are aged sort of towards the end of their career, towards retirement age, has actually been increasing over time. And that's come at the detriment of, sort of younger investors. We're just not seeing that sort of, 25 through sort of 45 age group make up as high a share of the population of investors. It's also worth noting, investing in property post-retirement is fairly uncommon. We do still see some investors aged, 65 through 75. There's not a lot over 75, which is perhaps not surprising. It's obviously hard to service an investment loan once you've retired, and the benefits from negative gearing aren't there once you've retired.
Yeah, another chart we can put up, it shows rental yields versus mortgage rates tracked on the screen. And I think what jumps out at me is you can clearly see home loan rates are falling, but rents, as you touched on earlier, they're not really moving anywhere.
Yeah, we've certainly seen the pace of rent growth slow down in recent years, and so what that's in the past year or so, and what that's meant is that gross rental yields have been fairly stable because home prices have still been rising as well. So the gross rental yield, that is the rent divided by the price of the home, has been sitting fairly stable after recovering over the previous years when rents were growing very, very quickly, contrary to what they had been doing during the pandemic, which it's hard to remember now, but rents actually fell in Sydney and Melbourne at the start of the pandemic. So we did see rental yields falling through that period, but they have kind of recovered since and been a bit more stable more recently.
And then looking around Australia, where are the really popular areas that investors are looking to purchase property?
Perhaps unsurprisingly, the most popular areas in terms of where we see investors overrepresented in purchases is inner city Sydney, inner city Melbourne. They're big rental markets, a lot of renters, a lot of rental demand, liquid markets, obviously a lot of investor interest in those areas. But outside of those perhaps obvious choices, what we do see is quite a lot of interest from investors in more affordable parts of our major cities. Think places like Ipswich in Brisbane or Parramatta or St Mary's in Sydney, places like Tullamarine in Melbourne. These are quite attractive areas for investors as well, partly because they tend to carry a higher rental yield. Not always, but on average tend to, and they represent a more affordable entry point than somewhere like an inner city Sydney.
And the price growth can be a lot better, can't it, in places like that compared to potentially the inner CBD areas?
We have seen that in recent years. More affordable parts of Australia have been outperforming the more expensive areas, which is, perhaps not surprising in an environment in which interest rates have risen very quickly. That's pushed housing affordability to some of the worst levels we've seen in at least 3 decades. In that environment, people have been looking for more affordable areas, more affordable options, and that's seen the prices for homes in those areas outperform more expensive areas typically.
All right, well, yeah, that brings us nicely on to home prices and how they've been going. I mean, just give us a sense of the property price growth this year in Australia.
Yeah, I think it's been a really interesting year for home prices, in many ways because it's changed what we've been seeing for the past few years. The past few years has really been a story of really divergent markets across Australia. We've had Adelaide, Perth, Brisbane growing at extremely rapid pace, 10, 15% per year through 22, 23, 24. That started to slow down this year. They're still growing faster than Sydney and Melbourne, but particularly in more recent months, the pace of growth there has clearly started to slow. And at the same time, Sydney and Melbourne, which, Melbourne particularly, have seen some pretty soft years recently. Both Sydney and Melbourne saw prices falling towards the back half of last year. In Melbourne, prices have been basically sideways to down for going on 3 years. But this year, both have actually been seeing pretty consistent, steady growth. It hasn't been, spectacular growth by any means. It's been sort of around average, maybe a little bit below. But it's a big change from what we've seen. We're sort of starting to see a convergence in the pace of price growth across our markets after a pretty big divergence in recent years.
It sounds pretty crazy for me to say this, but we're almost at the end of the year. It's almost Christmas when obviously the property market shuts down. But what are you expecting over the next 2 months when it comes to home sales?
Yeah, we're obviously heading into the sort of peak spring selling season when things activity specifically tends to really ramp up. And we're already seeing that. A number of listings in September was up relative to August, as we'd expect to see. Auction volumes are picking up, as we'd expect to see this time of year. It's worth noting Sydney and Melbourne had pretty busy springs last year, despite the softer price growth that we were seeing last year. We're probably not quite on pace as we were last year. Though, look, we've still been bouncing around relatively similar volumes this year as what we were seeing last year for auctions. Not quite as strong. It obviously changes week to week, but it's still been relatively busy. And as we head into spring, we'd expect to see that ramp up. In terms of home prices, what we've been seeing this year, that sort of steady, consistent growth around the country, I think it's fair to expect that to continue. The fact that the RBA's already cut rates a few times, there's a good chance they cut again this year, and if not this year, early next, is also supporting buyers. And so we'd expect to continue to see price growth.
Angus Moore from REA Group, great to have you on the show.
Pleasure as always. Thanks for having me, Ed.
That's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget, you can keep up with all the latest business news with our daily program, Business Now at 4:30 p.m. Eastern Daylight Time. Thanks for your company. I'm Edward Boyd. We'll see you next week.